Investors Playbook Live. As always, you have your co host, Deshauna Cornell, and we are almost at the end of 2025. There's a lot that this year brought us, but what we always want to make sure is that you all who are watching, our viewers, are prepared for what's coming next. So, next year, a lot of what's going to be changing. Well, not even really changing, but what we want to make sure that you all are on top of is a very important, sometimes difficult topic, but your taxes. 2025 taxes are wrapping up. You have about 2 weeks to figure out what you're going to be doing for 2020, for when you file in 2026. But knowing that taxes don't start January of that next year, we want to talk about the difference between planning for your taxes and preparing your taxes. So quick verses, right? Cornell, can you explain the difference between tax planning and tax preparation?
Yeah, so we spoke about this on an early episode also. So a lot of people they just feel like when they get the W-2, it's like this magic ticket, right? To where they put it into the system and they get money, right? So this is actually not the case. Um, Taxes are actually a lot more intricate than this, which is why people suggest if you make a significant amount of money or you have a business to have like a CPA or someone on your side to take advantage of these things. So tax preparation is what most people are looking for. And this is just getting your forms together and filing your tax return, right, for the past year. So you've done no thinking about it. It's like you just went through your life, and then now it's time to file taxes. So you pay someone, hey, do my taxes for me, right? But tax preparation, this is more intentional. This is you're starting from January 1st and you're intentionally doing things to decrease your tax liability. You see what I'm saying? So if you're actively working with a CPA throughout this whole time, throughout the whole year, then there's certain ways that you can reduce your taxes that you have to pay.
Right. Exactly. So, like Cornell is saying, most people think taxes start in January and end in April. That's not the case. That's only when the results show up, right? And the reality is the game is played the entire year. From January of 2025 to December of 2025 is when you are planning your taxes to then be prepared in 2026. It gets complicated, but it's actually quite simple. For the year before, you plan throughout the entire year, you prepare and you file the next year, right? And the reality is that it is a narrative that you can control. Your taxes, you have the ability to say how much you are going to essentially put towards taxes, how much you are expected to pay towards your taxes. It is all up to you. A lot of people are surprised because they don't control the narrative, like Cornell mentioned. They just go through life. They get a paycheck and they give that W-2 to TurboTax or whatever tax preparer, and then they get a refund or they don't get a refund. And something else, misconception. Getting a refund does not mean that you won. It does not automatically mean you won. It means that you paid too much money the previous year. And paying taxes doesn't mean you lost. The key is, did you control the outcome? Do you know that you are going to be paying taxes next year, or do you expect to get a refund? That is the key. All right. That is what's most important. Uh, Quick, everybody who just joined right now, we're talking about the difference between taxes being prepared and taxes being planned. Okay. Just so everyone is we're level setting. So everyone here, I imagine, is going to have to file taxes in 2026. So stay tuned. We got some real good info for you to help you plan and prepare. Well, prepare for 26, of course, but plan from January 26th to December 26th so that you can plan correctly for when you file your taxes in 2027. All right. That's the real
So
key. Go
I wanted
ahead.
to get your view on this because I know for maybe about the past 4 or 5 years, I've been for my 9 to 5 job, my W-2 job, I have been paying less in taxes to where I have to pay when tax season comes. I like this better because I feel like I'm giving the government a free loan if I'm paying them too much in taxes and I get the refund during tax season. Right? I like to get my money on the front end. I'm able to invest, put it places, and then I'll pay them when I want to
Yeah.
by April by tax day. You
Yeah.
get what I'm saying? I have all
Yeah.
the way until April to pay
Hmm.
them what I owe them. So how do you prefer to do your taxes?
I prefer to keep it balanced. I know with me, um, especially this year, because of the exchange of hands between my previous job and my new job, and with um, with all the different business ventures, it will be advantageous of me to figure out how best to make sure that my tax is even Steven. That's my goal. I know with the 9 to 5, I end up getting, I think I don't do any like deductions. I just kind of pay the regular amount of taxes. And sometimes I do get a refund, but that comes from the business expenses. The actual refund that I get does not come from me paying over in my 9 to 5, right? So I'm with you. I like to get my money throughout the year, and then pay what I owe towards in April of the next year, because that just, I mean, to me that makes the most sense. I'm able to do with that money at that time, right? I mean, we all know how, uh, what is it called, opportunity costs, and it goes into you not getting the money until April of the next year, right? That's you not being able to use that money the way you want.
Right.
Um,
And
but I
not
think,
just that,
hmm,
but you're missing on compound interest
yeah,
throughout the year.
exactly, exactly. So if you understand how to, when you are well, I guess, so that's the question, right? When someone is preparing to file their, it's not a W2 is what you receive in January, February. There's a form that you fill out when you are explaining to your job how much you want how much taxes you want taken out in your paycheck.
W4.
W4. And then I think for businesses, like if you are an entrepreneur, it's a
10.
I-9 or
Oh yeah.
1099, 1099, 1099.
Yeah.
Yeah. So all these different forms important, right? W4, you're explaining to your employer how much money you want taken out or how much taxes you want to pay throughout the year. So make sure that you understand how to fill a W4 out. And when your W2 comes, I mean, they do all the math for you. You just got to plug it in. So
Right.
that should be pretty straightforward. Something else that I want to make sure that people understand is that April 15th is important for personal taxes. But if you have a business of any sort, your taxes are due a month before. Your taxes are due March 15th. So don't think that the entrepreneurship venture that you decided is going to be, your taxes are due at the same time. You have one less month to prepare for business taxes. Granted, you don't need an extension, which you can file for that as well, but just keep that in mind, because that's when penalties start to hit. I remember we had to figure that out. You remember? We were new
And
to. Go
and
ahead.
it's something crazy too. I think it was like 250 a day. What was it?
Yeah,
It
it was
was
some ridiculous
or
number.
or maybe it was 250 a month.
Yeah.
Yeah, I
For
can't
every
remember what it
month
was.
that you don't file, they increase it. It reminded me of when we were at band camp, and I was like, every 30 seconds, I was like, this is impossible. you can't, you can't,
Yeah,
you're putting me in a hole that I can't get out of, literally. Like, how, yeah. So make sure that you don't miss those deadlines, and if they are coming up and you're still working on it, just extend. You have the ability to extend, and file your taxes later in the month if you need more time. They give you that as long as you file the proper paperwork.
right.
So with
So
go ahead.
okay. So there's definitely a lot of strategies that you can use when to limit your tax liability. A
Mhm.
lot of people invest in traditional IRAs or traditional retirement funds because these are deductible. Okay, because of the tax benefit, you're putting before tax dollars into, well, if you're using money that you already have, right? It's already came out your check, it's already been taxed. If you put that money into your retirement, then you get a tax benefit. You can write it off as a deduction.
Yeah.
Okay, that's where your retirement tax benefit comes from. And also, like if you're into investment or stocks, you can choose to sell your stock at a certain time. You can be strategic with it in order to limit your tax liability. And also, um, because short term and long term capital gains tax is different. Holding investments over a year, you'll be subjected to less taxes than if you were to be day trading, swing trading, or holding stocks uh, within the year and
Yeah.
selling.
Yep. And I'm a double tap on what you mentioned before the end of the year. Come January, you are now planning for the next year. So if you are putting money, though you can contribute to a Roth and a traditional from January, February to the previous year, that's not going to affect the taxes of the previous year. So if you're putting, for example, money into your traditional retirement account in February of next year, but you're putting it into your 2025 retirement account, those tax benefits are not going to go towards when you prepare for 2025 and 2026. I hope those numbers don't like it sounds kind of crazy, but pretty much after December 31st, all the financial decisions that you're making are going to affect your 2026 taxes. That's pretty much how that works. So you have until December 31st. All the decisions you make up until then is for 2025. January hits, you're talking about planning. You're planning on how you are going to execute preparing your taxes for 2027. Of course, you can go back and change, but you can't go beyond the bounds of January 25 and December 25. You feel me?
Yeah.
Yeah. In some special cases, I think that um with stock losses, you you can take those losses across multiple years. I will double check
All
that
that.
and make sure
Yeah. Because
I
that
will.
actually happened in my tax. I'm not a tax expert, but yeah, that actually happened with me. Because I know in 1 year, and I think this is insane. If you have the limit is a 3,000, you can only deduct $3,000
Mm-hmm.
from a stock loss. So say you lose $10,000, right?
Mm-hmm.
I know for that year you can only deduct 3,000,
3,000. Yeah,
which is insane. Because
it is.
my thing is, if I make 100,000, I'm gonna have to pay taxes on all of that
Yeah.
in 1 year. So man, it's the way it's set up is just I don't
Yeah.
know, man. It's a
Yeah,
scam.
I mean, it's the house. It's in favor of the house, right? It's in
Yeah.
like just like with any of these, they're not gonna put themselves in a position to where you can write off as many losses as you want because then people will just go OD with it, right? I imagine, but they can't too much because you don't want to lose stuff. Yeah, it gets kind of dicey. It doesn't necessarily work in the individual's favor. That's why you have to be strategic and operate according to the rules that they put in place. And yes, you can carry over your stock losses for multiple years. They call it capital loss carryover to offset future capital gains. So if you lose $3,000 in stocks or in stock losses, but you don't want to apply that to the year that you lost that money. You can apply it to a future year. So I guess that's one way you can go back and make changes. Yeah, like if you have one year that you know you're going to be making a ton of money, but you want to deduct $3,000 of it, and then you can do that. They call that stock loss or capital loss carryover.
How long does it last? Is there like a limitation to like how many years can you
Um, let
do
me
that?
see. I'm gonna see what's the limit or how for how long.
Yeah, how far? Because I would like to know that. Because if it just kind of stores it up in some type of database and you can pull it from there whenever, okay, so that'd be better. But I'd rather just be able to deduct all of it at one time.
It says
Yeah.
unlimited number of years. For
Okay.
US taxpayers, you can carry stock capital losses forward for an unlimited number of years until they are fully used up.
Oh,
No
so that's
time
perfect.
limit. Yeah.
Because I know
So,
one thing that I do
mhm,
is before the end of the year, anything that I'm just trying to any bags I'm trying to get rid of, I do it at that time.
yeah, that's it. So yeah, you can be real strategic. And that's the whole point, right? That's the point of this episode is to explain the different strategies that do exist. Retirement account is one of the easiest tax strategies, specifically traditional, because as you put money into your traditional Roth, your traditional 401k, those immediately benefit you the next year because you you can write those contributions off, right? With the Roth is different because you are getting the tax benefit after you retrieve the money or at the end of when you retire and you pull the money out. So keep that in mind when you're deciding on traditional versus Roth. Um, but yeah, that's we have retirement planning, that's one way. Stock losses carrying over, that's another way, up to $3,000. Um, what are some other tips, I guess, Cornell, that you want to make sure? You talked about short term and long term gains and the difference between how those are taxed differently. So the frequency in which you trade matters. Day trading, options trading, futures trading has gotten extremely popular. Um,
Student loan interest is
mhm,
deductible, so you can deduct that. HSA contributions.
yep.
If you're an educator, I know you can deduct up to I think it's either 250 or 300
Hmm.
without providing proof. Also, if you're if you have kids, you get a credit for those. I said
Yeah.
those like they were objects or something, but yeah,
For
you.
those things, you could they can help you a little bit. Oh, bro, owning a home. Owning a home is a huge tax benefit. Mortgage interest and property taxes. If you have a mortgage that you're paying and the interest that you're paying on that mortgage can decrease your taxable income. The property taxes, which in California are ridiculous, but the property taxes you pay can also be can also help you when it comes to you preparing for taxes. And there's something else called SALT, state and local taxes. So again, California, they hit you over the head. Those places where they have heavy state and local taxes, use that to your benefit. Of course, there's a cap. You can't just go willy nilly. So research the cap for your specific state, but make sure that you are going down the path of itemizing. They don't really apply if you use the standard deduction. You would have to itemize if you are going down the route of using, mortgage interest, property taxes, HSA contributions, nonprofit, you know, contributions, all that. You would have to go down the route of itemizing. But let's talk about that too. The standard deduction, right? Let's say you don't have all these different aspects and different ways. How much would what is the standard deduction currently for 2025?
It's 14,600, and if you're married and filing jointly, it's 29,200. If you're the head of household, it's 21,900
I think it went up, man.
for 2025.
Yeah.
Or are you talking about 20? Or are you talking about next year?
I see 15,750.
Okay.
Yeah. So slightly went up. And it looks like the next year it is gonna go up a little bit more. But yeah, if you're filing separately, um, slightly more, but that would be the standard deduction. And standard deduction means um you're not itemizing, you're not going specifically line by line and saying, I want to deduct this, I want to deduct this mortgage interest, I want to deduct um this at home business, I want to deduct mileage, like all those little deductions that can add up more than 15,750. If it doesn't, you might as well just go with the standard deduction. But if you see yourself creeping past 15,750, it's probably more beneficial to do the itemizing because you can probably get more deducted from your taxable income than just using the normal standard deduction. Yeah.
Yeah.
So that I think is important. And even repairs, home repairs. Like, bro, the stuff that you can use to deduct, it's expansive. So don't take what we're saying and use that as this is the golden standard. Like, no, research and see what else you could potentially use or potentially deduct. Because there's a lot more than what we're just saying on this episode. Like we're
Right.
covering a lot, but yeah, and everyone's situation is different. Go ahead. What you about to say?
And this is just like basic stuff. Of course, like if you want to get more in depth, you want to hire a tax professional,
Absolutely.
especially like if you have a lot coming in. If you're just a W-2 worker, you don't need to pay a tax professional. Okay, if all you have is a W-2, please do not waste your money. I see it all the time where people only have a W-2 and they feel like they have to pay this person $200 to file their W-2.
Right. And if it's simple, you don't. Like you can use something like TurboTax or yeah. It does not require you to go above and beyond. And not knocking the people that prepare taxes, that is a very lucrative job. And I'll even say this. I caveat and say this. We are not tax professionals. Cornell just said it, but I'll repeat it. We are not tax professionals. Um, there are individuals who have went to school for this, who have certifications in this. We are just aware and have educated ourselves on a lot of the intricacies of taxes, right? But
Which is important with anything that you have to deal with, like even investing. Like
yeah,
some people just give their stuff to a financial advisor, and I just I just try to educate myself in as much as possible, like just so you don't make crazy mistakes. Like that time where I met that woman who was putting money into a Roth IRA, and she was in her 70s, and she had $80,000 in there and nothing was invested. If she had just taken the time to learn a little bit about
yeah,
investing, that would have never happened.
yeah. That's sad, man.
You can't depend on other people for your life. Like you got to know something.
Hmm. You have to.
I don't have that level of trust where I could just hand something like my retirement off to somebody and be like, "Hey, just do what you do."
I imagine that she didn't even hand her retirement to somebody. She
Because it
had to
was
have just she had to have been thinking that as the amount increased, that's investing. But that's one of those and people say it, you don't know what you don't know, and that's true. But sometimes you just gotta seek. And I don't really know what that answer is. It's different for every person. It's different for every situation. But sometimes you just have to seek because someone is not gonna always give you the answer, and you're not always gonna stumble across it. You have to be intentional and say, what is what this thing that I'm doing, what about it don't I know? And just explore, right? You just got to explore. You might find something that is reliable or useful. You might find stuff you already know, but you won't know that until you dive deeper in this thing that you know a little bit about.
right.
So, yeah, I think it's very important.
So my thing is always continue to learn
Hmm.
and just apply what you learn. Don't just look at things and be like, "Oh, that sounds cool."
Right.
Like, see how you can apply it to your life. Because if you learn something and do nothing with that information, you might as well not even have learned it.
Yeah. You're just sitting on it. Education is powerful, but execution, I think, is way more powerful than education. You got to have both. You got to execute with the education that you got. Um, yeah. So, yeah. We want to make sure that if you are watching this episode, that you are understanding taxes do not start. I mean, technically they start in January, but we're talking 2027 at that point. But taxes for 2025 don't start in January. That's when you start to prepare. But planning for 2025 taxes start in January of 2025. And in 2 weeks, when January 1st, 2026 starts, you need to be planning for your 2026 tax preparation, which won't happen for almost another year and a half later. But you start planning now. It's always good to plan now so that when it does come time to execute and prepare and file, there are no surprises. You're not like, what? I owe this much, or that's great. Like, you just be aware of it and you can control that narrative, right? You can
Yeah.
decide and document everything so that you know what it's going to look like in 2027. And I think the best part is you can choose to uh well, not to some degree, you can kind of choose how much you want to. It depends. If you have like a business
If
and
you
you
have
can,
assets, right?
yeah, if you have assets, you can control how much your income will be in 2026. You can
Your
take more.
realized income.
Yes, your realized income. Taking money, like selling stocks, increases your realized income.
Right.
Things like that, right? You can literally offset on purpose the taxable, your taxable realized income. It's just a lot you can do, but you have to be at the driver's wheel and you have to kind of know where to go. But if you
You gotta be
just,
knowledgeable.
yeah, if you just in the back seat and just like, all right, well, take me somewhere. That's why 2027, sometimes people get surprised. Or even this upcoming tax year, people are going to be like, how did I get here? Why do I owe so much? And it's all just math. Well, I can't say that. It's also knowledge and it's also understanding tax. It's a lot to it, but it's not something that is impossible to learn. Even if you just understand the things that apply to you owning a home, having a business, donating to charity. Everything in the tax law might not apply to you, but some might. And that's when you got to start researching that type of stuff. So, yeah, man. All
Yeah.
right. Good.
All good. Yeah. Just keep seeking knowledge, y'all.
That's it. Keep seeking knowledge. And also, 2026, y'all be ready for the investors playbook community. All right. We want to make sure that people are able to have these conversations with us and not just on a Sunday in the chat. We want this to be a consistent conversation that happens. So, y'all just be on the lookout for that. 2026, we know times are tough. We know that it's hard, but we want to bring individuals who are wanting to get their financial journey back on track and then also elevate and scale. uh, so y'all just be ready for the 2026 Community Investors Playbook is definitely wanting to pour back beyond the podcast, where we can actually answer real questions and provide y'all with tons of opportunity and knowledge. So just wanted to put that out there. We got one more episode before the end of the year where we'll talk a little bit more about the community. But for now, yeah, we'll leave it at that.
All right, y'all.
All right. Look, another episode in the books. Appreciate y'all for tuning in. Peace.
Peace.